Hi, how are you doing? This is the lecture for Class 4A, so it's the first half of class if you're in the Tuesday, Thursday class schedule, and this is Class 5 on Monday, Wednesday, Friday schedule. So we're going to be talking about Chapter 2 finally. In Chapter 1, we learned about organizations and how accountants are keeping track of all the transactions at an organization. And we've learned that we use the accounting equation to make sure that those transactions stay in balance, right? Assets always equal liabilities plus owner's equity. A equals L plus E, AL. So we learned that we report out the information that we gather on the financial statements. But those financial statements are aggregates of all the transactions, so we have to keep track of each transaction so we can report it out as totals on those financial statements. So Chapter 2 is where we're going to start talking about how do you actually track the transactions at your organization. So we're going to learn how to actually do that tracking. Sorry about that. Alright, so the first thing we're going to do is look at how to record transactions. Alright, so what is an account? Well, we're using the accounting equation to track everything. Alright, so it's got the three parts, right? Assets, liabilities, and equity. The account itself is a more detailed record, so it's not just assets, it's a specific type of asset, right? So the accounting equation is the basic tool of accounting. The accounting equation is made up of three categories: assets, liabilities, and equity. Each category contains accounts, which is a detailed record of all increases and decreases that have occurred in an individual account during a specific period. So we're not just going to talk about assets, we're going to start talking about specific assets like cash, like land. So if you think to monopoly, all right, the account chart of accounts tells you the assets, the liabilities, and the equity accounts. So all those listings, those are the accounts. Let's talk a little bit about assets first. So assets are something the business owns or has control of that has value, right? Assets are economic resources that are expected to benefit the business in the future. So we have a lot of examples that came up, like cash, accounts receivable. We've already talked somewhat about assets in Chapter 1. Equipment, building, land. A new special kind of asset we might talk about is accounts receivable. Accounts receivable represent a customer's promise to pay monies in the future for services or goods already provided. Equipment, furniture, fixtures, land, all are assets used by business in operations. Right? So when you think about what they do for a living, these companies have operations they're running and they use all this equipment. Two new assets introduced are notes receivable and prepaid expenses. All right, so if you look on this chart here, you'll see something we haven't heard. Of course, we've all heard of cash, right? Well, we're going to start talking about two new assets: notes receivable and prepaid expenses. Notes receivable represent a promise to pay by a customer to pay a fixed amount of money along with interest on a specific date. Generally, notes receivable require a formal promissory note, which includes a stated interest rate. So it's a note. Like, imagine when you buy a car, you sign a note, right, with the bank. Well, sometimes customers sign notes, especially for a very big purchase. You can imagine that if you're a farmer here and you go up to Robstown and you buy a new tractor for using on your farm. That's very expensive. You might sign a note receivable when you buy that. Prepaid expenses are expenses paid in advance that are expected to benefit the business in the future. Example of prepaid expenses are prepaid rent, prepaid insurance, and office supplies. So these are some new kinds of assets. So note receivable, just like it sounds, somebody owes the company a note and they'll pay that back. And prepaid expenses are an asset because you've bought those up front. So you can imagine if you paid 6 months of your rent up front, right? Well, that's an asset. You get to live in that apartment for 6 months. That's something of value in the future. That's what the definition of an asset. So prepaid expenses are when you've paid something up front. Supplies, if you buy a box of pencils and you're going to use that box of pencils for the next year, you're not going to use them all up at once. That's a prepaid expense we call supplies. All right, let's talk about liabilities. We talked about assets and some of the accounts under the asset category. Now we'll talk about liabilities and some accounts under the liabilities. So as you may recall from chapter 1, a liability is a debt, something that the business owes. A business generally has fewer liabilities than asset accounts. A payable involves a future payment of cash. So when the organization owes some money, we call that a payable sometimes. A note payable, this is a specific kind of account called a note payable. A note payable is a written promise made by the business to pay a liability in the future and generally includes interest. Right? So that makes sense, right? If you own a restaurant and you're the accountant for that restaurant and they have to buy some big thing like a new oven for the restaurant and it costs thousands of dollars. They don't have cash, so they take out a note payable and they owe money and for that oven purchase, right? It's a note payable because they've signed a note and they're going to pay interest on it. You might have a note payable for your car. Okay, next is another new kind of liability, right? We call it an accrued liability. All right, so an accrued liability is an amount owed for goods or services provided but not yet paid by the business. Okay, something that's typical for an accrued liability would be taxes payable. You know that as you're making sales at your business, you're collecting sales tax. But most businesses don't send those in until the end of the quarter. So you have a tax payable or a salary payable. Like I get paid once a month, right? So I've worked the whole month of August and I've worked the month of September and I'm not going to get paid till October 1st. So the university has a salary payable for me. So those accrued liabilities are they're accruing. In other words, there's not actually any money has changed hands yet, but they still owe it. It's still a liability that they owe. Then, finally, there's another new kind of liability called an unearned revenue. So unearned revenue occurs when a company receives cash from a customer before the business provides the goods or services. So unearned revenue, so we don't get to actually claim revenue until we provide the good or the service. So sometimes people pay up front. Like when you graduate, you're going to get your diploma framed in a nice diploma. And when you take it to the frame store, they're going to say, oh, we need you to pay up front. All right, so you pay up front and they haven't given you your frame yet. All right, so that's actually not revenue to them. They haven't earned it. They don't earn it till they frame the diploma and give it to you, even though you've paid cash up front. So they have unearned revenue. Same thing, let's suppose you decide to hold a concert and raise some money by having a concert and you sell tickets for that concert. And you sell 100 tickets for $10 a ticket. You got $1,000 cash in your hand, but you haven't put on the concert yet. right? So that's unearned revenue. When you do the concert, now you've earned it. But until you really earn it, it's a liability because you still owe something. You owe a concert, right? To the frame shop, they still owe a frame to you. So you have to think about liabilities in terms of something owed, all right? So an unearned revenue is something they owe. All right, so next, equity. So you know equity accounts, that's the owner's claim to the business, right? Assets, the difference between assets and liabilities are the equity in the business. So a stockholder's claim to the assets of the business is called equity or stockholder's equity. A company has separate accounts for each element of equity, right? So equity is increased for common stock and revenues and decreased for dividends and expenses. So as the company enters into business and as it does business, it's changing the owner's position, right? Because hopefully the company makes some money for the owner, right? And as the company makes money for the owner, that belongs to the owners. That becomes their equity. So as revenues come in, that increases the equity, right? Because that's money coming into the business, and if the owner owns the business, it belongs to the owner. It's their equity. As you pay expenses out, that's money leaving the business. So it's reducing the equity. Let's talk about a chart of accounts. All right. So you may recall from Monopoly that we have an actual chart of accounts for Monopoly. It tells us all the accounts in each category that we can use for keeping track of transactions at Monopoly. If you look at page 59 in your book, it gives you an example chart of accounts for a company called Smart Touch Learning. And you'll see it looks kind of similar to our Monopoly chart of accounts. It's just got some different accounts. Because Smart Touch doesn't have railroads. But in Monopoly, we have railroads. So our chart of accounts is going to be a little different. So if you look at that chart of accounts, you'll see that a chart of accounts is used to organize a company's accounts. A chart of accounts lists all company accounts along with the account numbers. Account numbers are just shorthand versions of the account names. Each account has an individual account number, similar to how Social Security numbers are unique for each of us. The chart of account varies from business to business, although most account names are common to all companies, right? So all companies are going to have miscellaneous expense, they're probably going to have rent expense. So there's a lot that's the same, but it's just depending on the company, they may have some slightly different accounts. Like at Monopoly, we had utilities investments, right, and utilities income. But some companies don't have that. They have different sources, right? In addition to a chart of accounts, companies need a way to show increases and decreases. A ledger is used to complete this task. A ledger is the collection of all the accounts, the changes in those accounts, and their balances. A ledger provides more detail than a chart of accounts. So a ledger is, just think of it as keeping, we've heard of keeping the books, right? You're keeping books for the company. The accountant is the bookkeeper. Well, your ledger, that's the books that you're keeping. All right, so let's talk about a little bit about how we actually do enter these transactions into the ledger, right? Because that's what we're doing, is transactions, right? So as we started playing Monopoly, you will see that everything that occurs is a transaction, and we got to record it to keep record of that for our business. And there's specific ways we do this in accounting, right? So there's special ways we write it down. We debit accounts and credit accounts, and it represents something. So we're going to start learning some of the special accounting terms for keeping these records. All right, double entry accounting. So in accounting, the double entry system is used to record the dual effects of every transaction. A transaction would be incomplete if only one side of the transaction were recorded. In addition, recording only one side of the transaction leaves the equation out of balance. Remember, we always have to have A equal L plus E. So whenever something happens on one side of the equation, something has to happen on the other side or on the same side to keep it in balance. That's why we call it double entry, because there's going to be a balancing entry. All right, for example, suppose you purchase office supplies with cash, right? So we've increased office supplies, which is an asset, right? And we've decreased cash, which is an asset. So they both, an increase and a decrease occurred on the asset side, so we're still in balance, and that was 2 entries. 1 to supplies and 1 to cash. T account. We're going to use T accounts in Monopoly as well. T accounts is just like a symbolic way accountants represent the ledger. All right, so you can imagine that if I'm using a T account, I'm an accountant, I just like draw a T. It's easy to write, 500, 600, 700, 200, one on either side of the T. I'm just doing some real quick bookkeeping with a T account. All right, so a T account is a shortened form of the ledger, and it's just called a T account because it resembles a capital T. The name of the account is listed on the top of the T. The left and right sides of the T are used to record increases and decreases in the account. So here's an interesting accounting term. Debit is abbreviated as DR and credit is abbreviated as TR. So in this example you see of a T, this is an example of a T account. And so if I was going to be tracking some cash, I would just draw on a piece of paper a T, right? And I'd write cash, and then I'd start doing my transactions on either the left or the right side, right? So that's all a T account is. And so this is showing you debit, or DR, on the left, and credit, or CR, on the right. And that's all that means, is debits go on the left, and credits go on the right. So if you can just remember that, debit and credit, debit's first, credit's second, left, right. So that's your T account. Debit's on the left, credit's on the right. I don't know why they abbreviate debit DR. I think it's like a Latin word, like when they invented accounting back originally. It was like, it wasn't just called debit, it was probably like debitorum or something, and it had an R in it at some point. So DR and CR are how we debit them, even though debit doesn't have an R in it. Now, this is kind of interesting here. We're starting to get into how we increase and decrease accounts, all right? And do we increase or decrease using a debit or a credit, all right? So, if you can just memorize this, that will be great, all right? So here's your equation. Assets equals liability plus equity. A equals L plus E. All right? So if we're recording asset accounts like a cash, like land, right? So if we're recording asset accounts, and I want to increase an asset, like let's say you gave me some cash. So I need to increase the asset cash. I do that with a debit. See how it's got the increase, right? Suppose I decrease cash. Let's suppose I spend some money. I go out and I buy some office supplies. I need to decrease cash. I do that with a credit. All right? So assets increase with debits and decrease with credits. Now because we have to always keep our equation balanced, on the other side of the equal sign, A equals L plus E, it's flipped. So when I increase liabilities, I increase them with a credit and decrease them with a debit. Same thing for equity. Increase with a credit, decrease with a debit. And that way, right, depending on, I can always stay in balance, right? I'll always have debits and credits, and I'll always keep my equation in balance. So assets increase with debits, liabilities and equity increase with credits. All right? So just depending on what kind of account it is, how you analyze a transaction is you go, what account am I affecting? I'm affecting cash. Am I increasing it or decreasing it? If I'm increasing it, that's a debit. if I'm decreasing it as a credit. Let's suppose I'm affecting an equity account. Well, am I increasing equity or decreasing it? If I'm increasing equity, I post a credit. If I'm decreasing it, I post a debit. Let me go back and give you the fill in the notes for this. Increases and decreases to an account are determined by the type of account: asset, liability, or equity. Depending on the type of account, increases are recorded on one side and decreases on the opposite. Assets are always increased with a debit and decreased with a credit. Liabilities and equity are always increased with a credit and decreased with a debit. Debits are not always increases or always decreases, neither are credits. The debit or credit designates which side of the T account the transaction is recorded. Really just means left or right. Okay, so let's get into this a little more, right? You'll start to understand it. We'll practice it in Monopoly, and I think it'll start to make sense. Let's assume a company enters into a transaction that increases cash, right? When you increase cash, here's cash. This is what we call a T account. It's representing our ledger. It says cash at the top, so the left is always debit, right is always credit. I mean, you just memorize that. Left, debit, right, credit. Because cash is an asset, it increases with a debit. So if you're increasing it, you put the $30,000 on the left or debit side. If you're decreasing cash, you put it on the credit side. That's all that is. All assets, cash included, increase with debits, decrease with credits. Now, we have to think about equity in terms of how we increase and decrease it. And quite frankly, equity increases and decreases several ways, right? We have stock, we have dividends, we earn money, we pay expenses. So we have to think about how the debits and credits work for equity. All right. So the accounting equation is expanded to include the 4 types of equity accounts: common stock, dividends, revenues, and expenses. So equity is subdivided into some categories: common stock, dividends, revenues, and expenses. Common stock and revenue increase equity, right? It gives the owner more equity. When we issue common stock, that shows, oh, I'm an owner, I own more stock. Or when a company earns money, right? When they get some revenue in, really, think about it. If the company's earning money, it really belongs to the owners. So revenue increases equity. All right? But when transactions cause equity to leave the company, like we pay out some dividends or we pay out some expenses, that decreases equity, right? So you may recall that we said equity increases with credit and decreases with debit. So you have to think about, okay, what kind of account am I dealing with? So if you're talking about an equity account, you have to think, okay, is this the kind of account that increases equity, or is this the kind of account that decreases equity? So you think, okay, common stock and dividends, all right? Common stock increases equity, dividends decrease equity, revenues increase equity, expenses decrease equity, right? So you have to kind of prime yourself to think about categories. That's all accounting really is categories. All right, so I tend to remember, here's how I kind of remember it. We know that revenues increase equity. We know that equity increases with credits. We know credits are on the right, so I always think revenues on the right, RR. That's how I remember it, revenues on the right. So if I know revenues are on the right, the opposite of them, expenses, have to be on the left. So all I worry about is revenues on the right. So that's how I remember that, RR. Let's talk for a minute about something called a normal balance. All right, all accounts have a normal balance. So think about if you're keeping track of some accounts, right? Keeping track of cash and accounts receivable and accounts payable and common stock. You're keeping track of all these accounts. There's going to be some account, the account is going to either be normally a credit balance or normally a debit, right? There's going to be typically some way you keep track of it. So we call an account's normal, all accounts have a normal balance. An account's normal balance is on the side of the account that increases the account, right? So if you have cash, cash increases with what? Debits, right? It's an asset. Assets increase with debits. So that means that for any asset, the normal balance should be a debit balance. Same things with anything else that increases with debits, which are dividends and expenses. Now, revenues, liabilities, and equity increase with a credit. So the normal balance for these accounts is a credit. So you just think about, once you learn the rule, assets increase with debits, liabilities and equity increase with credits, so you can understand which is the normal balance. So if you look, this is something you can memorize. I mean, I think as time goes by, it'll just kind of become natural that you'll just automatically know, oh, assets increase with debits. So cash would have a normal debit balance. Accounts receivable would have a normal, just to kind of know, you just don't have to think about it. But for now, if you want to memorize, you can. So assets and expenses and dividends increase with debits, therefore the normal balance is a debit. Liabilities, revenues, and common stock increase with credits, therefore have a normal credit balance. So, what's the point of this? Well, if you think about it, we're learning how to increase or decrease an account because, well, at the end of the day, I need to report out the balance on that account, right? So think about, we learned about the income statement, the balance sheet. We just want to know, well, how much cash do we have on this day, right? How many receivables do we have on this day? What was our revenue for the month, right? We want those totals, right? Well, to get those, what we've been doing all throughout the month or the quarter or the year is tracking a debit and a credit every time a transaction happened. I've been doing my debits, my credits all along. And so at the end of the day, month, year, whatever, I want to know what's the balance. So that's where we come along in balance. All right? So we can use our T accounts as an example as a way to do that. So the T account is used to obtain a summary or balance of a particular account. The summation of the account is reported on the side of the T account with the larger number. For example, if the total debits for cash equals $35,500 and the credits are $23,200, the normal balance is $12,300. The total of the debits is subtracted from the credits to determine the ending balance. So for example, on this account here, cash, you can see that we debited $30,000 and we debited $5,500, right? So those were increasing cash. Over here, we've credited $20,000 and we've credited $32,000. Those were decreasing cash. So when I add these and subtract these, my balance is $12,300. So that's how much cash is in the cash account. All right, and that's it for this lecture. For those of you who are in the Monday, Wednesday, Friday class, now you're ready to go work on your homework and turn that in. So check and see what that is. For those of us who are in the Tuesday, Thursday class, there's one more video to watch. So you go find video 4B. Maybe take a little break and find video 4B, and we'll talk a little bit more.